Most people who start trading lose money, not because markets are impossible, not because institutions are cheating them, but because they are playing the game at the wrong scale. Open almost any trading platform, and what do beginners do first? They zoom into the 1 minute, 5 minute, or 15-minute charts. They stare at every tiny price movement. Every candle feels important. Every move feels tradable. And that's exactly where the problem begins. Because the lower the time frame, the more noise you are trading. The data reality. Financial markets move on multiple time horizons, but the shorter the time frame, the more price movement is dominated by random order flow, high-frequency trading algorithms, liquidity sweeps, bid/ask fluctuations, market microstructure noise. Academic market and microstructure research has shown that very short-term price movements often resemble random noise rather than meaningful trends. In simple terms, the smaller the time frame, the harder it is to distinguish signal from noise. That's why many professional funds and long-term investors base decisions on daily, weekly, or even monthly data instead of intraday charts. Not because they can't trade faster, because they know most intraday movement isn't meaningful. The psychological trap. Lower time frames also create a psychological problem. When you catch a 5-minute chart, you feel pressure to trade constantly. You react emotionally to every move. You overmanage positions. You exit winners too early. You chase moves that already happened. Behavioral finance research has repeatedly shown that frequent trading leads to worse performance for most individuals. A famous study by finance professors Brad Barber and Terrence O'Dean analyzed thousands of retail brokerage accounts and found that the most active traders consistently underperform the market. Not slightly, significantly. Why? Because trading more often increases transaction costs, emotional decisions, reactionary trades, overconfidence. The weekly candle perspective. Now zoom out. Instead of staring at hundreds of candles per day, look at one candle per week. A weekly candle contains 5 full trading days of data. That means it absorbs daily volatility, intraday noise, short-term emotional reactions. What remains is a much clearer picture of the underlying trend. This is why many long-term trend followers focus on higher time frames. Not because they are lazy, but because time frames filter noise. The weekly candle strategy. The concept is simple. Instead of reacting to every price fluctuation, you make decisions once per week. Here's the framework. Step 1. Wait for the weekly candle to close. Markets often look bullish midweek and bearish by Friday. Acting before the weekly close means you're trading incomplete information. Waiting for the close gives you the final verdict of that week's battle between buyers and sellers. Step 2. Identify strong weekly structure. Focus on clear structures like higher highs and higher lows. Uptrend, lower highs and lower lows, downtrend, major support and resistance zones visible on the weekly chart. These levels matter more because large institutions operate on longer time horizons. Step 3. Trade fewer setups. A weekly strategy dramatically reduces the number of trades. Instead of dozens of impulsive entries per week, you might see 1 or 2 real setups. This forces discipline, and discipline is one of the biggest differences between losing traders and consistent ones. Why this works better for most people. The weekly approach fixes 3 major problems. 1, it removes noise. You stop reacting to meaningless intraday movement. 2, it reduces emotional decisions. You analyze once per week instead of reacting every minute. 3, it forces patience. Patience is not a motivational slogan in trading. It is a risk management tool. The brutal truth. There is no strategy that guarantees profit. Markets are competitive environments with millions of participants, including institutions with vast resources. But the reality is this. Most beginners lose money because they are trading too often on time frames that are too small, reacting to information that doesn't actually matter. Zooming out to the weekly time frame doesn't magically make trading easier. What it does is remove many of the mistakes that destroy accounts. Less noise, fewer trades, more meaningful market structure, and sometimes the biggest edge in trading isn't finding a secret indicator. It's simply looking at the market on the right time frame. Be sure to subscribe for more